Hello, I'm Brian Roten, Senior Reporter for Hotel News Now. I'm here with Leeny Oberg, Chief Financial Officer and Executive Vice President of Development at Marriott International, and we are here at the NYU International Hospitality Industry Investment Conference. Leeny, thank you so much for joining us here today.
Great to be with you, Brian.
First part of the year, not so great. Things seem to be looking up. At your earnings call at the beginning of May, you guys had a very positive outlook for the rest of the year. So let's take a dive into there and what is going on in the, domestically, what's going on internationally that gives Marriott such a positive outlook for the rest of the year after let's call it a challenging first quarter.
Sure, happy to talk about it. No doubt the demand for travel is robust. And we really like what we see from the three fundamental sectors of demand for our business, which is obviously leisure, group, and then business travel. And while they may kind of be in various stages of either recovery post-COVID or normalization, the reality is they're all quite strong. And the U.S. had an anomaly in the month of March from a standpoint of a comparison of Easter a year ago versus this year, Easter being in Q1, which did lower RevPAR for Q1 a bit. But then sure enough, in April, that really bounced right back as a result of Easter having been in Q1. And then when you look more broadly and you think about the fundamentals that drive our business, and you see a fairly stable economy in the U.S. and a continued really great interest in travel, both domestically and abroad, that it does bode well for the industry, not just this year, but for years to come.
And as we're looking at where the economy is right now, we see that some of the hotels in the lower end of the segments, they're having a little bit of trouble. Upper end, people who are able to travel, they can still afford, they're still traveling. But as you look at the economic environment for right now, we saw GDP slow down a little bit, still growing, but a little bit slower. Any cause for concern, or do you think that it's still we're still going to see growth, even if not as robust as before?
I think you've got various things going on. First of all, is just at the very highest level is continued interest in travel and tourism. When you look at the expectation for both numbers of trips and travel expenditures, they are expected to grow faster than global GDP, and frankly, faster than GDP within most countries for travel in that country for really over the next 10 years, so kind of first and foremost, when you look at the basics of our demand patterns, that's a really strong characteristic. Now, to your point, we will always be impacted by economic cycles. That is the nature of the beast for us. And so when you imagine that the U.S. economy with higher interest rates could see some slowing, we would expect that obviously that has an impact on certain segments of our business. But when we have talked about broadly expecting RevPAR of 3 to 5% globally this year, with a hefty amount coming from both occupancy and rate, I think you'd call it a really healthy sort of production number. And that then you add on top of that the ability to grow rooms 5.5% to 6% for the company in 2024, I think leads to some really strong numbers overall for earnings and cash flow for the company.
You had mentioned interest rates. We've been watching and waiting to see what the Fed is going to do with interest rates this year. There have been hopes of a cut or multiple cuts, and as each month goes by without any kind of clear indication that yes, we're going to have one, what are your thoughts on how that is affecting the way that the owners you work with are able to plan out new projects, or is holding interest rates where they are steady enough to keep development going.
You certainly have seen investors get more used to these kinds of rates. And I do think with a bit more stable view of where rates could be, and I think that view does assume that they will be higher for longer, never mind exactly when we see the Fed do the first rate cut. I think that just a more stable picture has helped in terms of the development views. So we are seeing higher construction starts in the U.S. than we were a year ago. In our first quarter, we actually saw 25% higher construction starts than a year ago. But that is also not the same as what it was pre-COVID, from the standpoint that construction starts were meaningfully higher pre-COVID, when you saw interest rates being very, very close to zero. At the same time, financing for strong brands, strong locations, well-known developers who have a proven track record, I think you absolutely are seeing availability of financing, which helps lead to this continued growth in construction starts. And then, as I'm sure you've heard us talk about, we've seen quite a number of conversions. So as you see hotel owners either decide to buy a hotel, that they decide to change the brand and put it where they think they're going to get a great return on their investment. It isn't adding supply to the overall system, but it is adding to our portfolio. And we are now expecting, almost a third of our room openings to be from conversions over the next few years. And that's not just in the U.S., that's a global number, which I think really demonstrates the power of the Bonvoy platform and of Marriott's brands.
On the development front, what is Marriott doing to work with developers to help out either with new development or with conversions? I believe it was the Turtle Bay Resort that Marriott offered, was working with Host, providing some key money to convert that over. I mean, huge property, wonderful property, big get. What are the options that Marriott sees for itself? And I got to imagine a thing like the Turtle Bay is probably going to be kind of a unique circumstance.
Well, certainly we hope not, from the standpoint of we love to see conversions like Turtle Bay into the Ritz-Carlton portfolio. And actually, you saw that this morning we announced 3 North American conversions. One that is going to be a St. Regis out in Newport Beach, California, Pelican Hill, and then a new luxury collection hotel in Manhattan. And all 3 of those hotels will open up later this summer. So just great recognition of the strength of our luxury brands and our luxury focus, but also a recognition that, as you say, we really work with owners and franchisees to make the product work across all the different segments. So whether it is at the luxury end, where we have excellence in operations and really a unique brand delivery on the service side, where there may be things like key money involved, then you take that all the way down to the mid-scale segment, which, as you know, Brian, we've really entered in the last year. One more of a new build type product, which is Studio Res, where we've got 140 signed projects with another 100 that we're working on. The overwhelmingly extended stay new build type product that we have worked hard to make sure that the cost per key and the charges for the affiliation costs and the productivity model in that hotel work well for the owners at really a spectrum quite far away from the luxury side. And then also this week we have announced the Project Mid-T, which is more of a conversion mid-scale transient product, which again fits very well with both what we see customers wanting for the entry point into Bonvoy, if you will, where someone is perhaps traveling to a secondary or tertiary market and would love to have a Marriott product, and owners and franchisees really hungry for the ability to have flexible options as they see a hotel that may be 25 years old and they're imagining where it really fits in the market today, gives them another option to consider with Project Mid-T. So we really do try to make sure that the products are working for the customers in terms of having every kind of experience you want wherever you want it at different price points, but also really considering the owners and franchisees and what they need to make it a strong ROI investment.
So when you're looking at from the entry point of the mid-scale space for Marriott, and then as you're planning out where you're looking to grow organically, to start your own or to acquire as you did with the City Express, where do you decide, like, yes, this is where we want to go this route for the organic, our own, and this is where we're going to plan to grow it here, and here's like, well, we're going to buy this and grow it further there?
It's a mixture of both planning and studying the markets and the market opportunities, but it's also opportunistic. So when you look at anything from AC hotels, which we did, almost 15 years ago, to City Express, where we knew that we really wanted to get into mid-scale, and we knew we wanted to do it globally, but we also wanted to do it in a way that had the product fitting the market need in that market. So, for example, City Express in Mexico, which is a fantastic brand, largely a transient brand, and will likely be a lot of new build, some conversions as well. While at the same time in the U.S., when we began to enter the mid-scale, we were envisioning what we thought from all of our conversations was a particular niche in the extended stay market that Studio Res fit. So it's really making sure that as you look at the various markets around the world, and the segments, and you see where the demand is and where we may or may not be already, that then we explore the opportunities to either start a brand organically, as we have clearly done in the U.S., or take the opportunity to get something like City Express and then grow it. And what's been nice about City Express is that it's a well-known brand in CALA, and has really made us the number one player there and in Mexico, and in that regard, given us lots of great growth opportunities by having the brand and seeing the brand perform really well after we bought it.
And I think our readers and listeners are going to want to know a little bit more about this conversion-friendly brand that is new to them. What more can you tell us about it and the creation of it?
Well, I think the audience, first of all, on the consumer side, is obviously a value player, but someone who's looking for all the great benefits of being part of the Bonvoy platform. Obviously, the points, knowing that you're going to get a very dependable experience and be taken care of the way that you would expect, and very clearly be able to find where it is, how to book it, wherever you're going. But it's definitely on the value play, while from the owner and franchisee, I think, as I was describing before, it gives them more flexibility as they think about an existing hotel, that they can either decide to invest and have that hotel be at a certain segment. It gives them more options, and ones that they really appreciate having the opportunity to have one with Marriott. One of the things that we've done that I think is unique in the mid-scale space is that we are charging just one affiliation fee that kind of includes all of the mandatory things that you need to be part of our system. And I think more classically, historically, you've seen the industry say, all right, we'll charge you this for reservations, this for loyalty, this for the property management system. And the idea is with a bundled affiliation fee, it makes it much easier for the owner and franchisee to value their asset, to think about as revenues are going up and down, what is that going to mean for the cost structure of that hotel? And then obviously to also put into place a super efficient operating model at the hotel level. So about making sure that you are putting operating strategies in place that take advantage of all the productivity gains that we've made over the past 5 to 10 years in place at this particular brand. You know, we've done really well in the select brand space in terms of delivering great returns to our owners and franchisees, and this adds one more opportunity for them to invest with us.
Well, thank you, Leeny. Any final thoughts before we close out here?
No, only to say that we're very enthusiastic and encouraged by what we see in the space. I think travel has normalized in the U.S., but it has normalized to a level where it is still clearly a priority for our customers. And that's both domestically and internationally. And so we see that the benefits of having, everything that you can do on the Bonvoy app and all of the locations and the growth opportunities, as we talked about these new luxury conversions today, I think gives us lots of optimism for the years to come for Marriott.
Well, thank you, Leeny, and thank all of you for listening. Stick with Hotel News Now for further coverage.
Thank you.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen and Lodging podcast on the Hotel News Now podcast network. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of the Hotel News Now podcast network was recorded on June 3rd, 2024 by Brian Roten and edited by Rachel Daub. Check out this and more at hotelnewsnow.com.